February 27th. Circle that date. Write it down. That's the day COMEX has to deliver silver they don't have. 19 days from now, 429 million ounces of open interest, 103 million ounces of registered inventory, and the delivery rate just hit 98%. This is not a futures market anymore. This is a bank run, and the clock is ticking. This is the silent ledger, and what I'm about to show you is not speculation, it's mathematics. COMEX has 19 days to find 200 million ounces of silver that doesn't exist in their vaults. And every single day that passes, the problem gets worse. Here's what nobody's telling you. The system was never built for this. For decades, the futures market worked on one simple assumption. Nobody asks for delivery. You buy a contract, you sell a contract, you roll it forward, you cash settle. The metal never moves. It's just paper changing hands. That's how fractional reserve commodity trading works. The amount of silver promised on paper far exceeds the metal that could ever be delivered. But the system didn't collapse because of one critical assumption. Nobody would ask for delivery all at once. In January 2026, that assumption failed. And COMEX is now staring at a problem they cannot solve with margin hikes or cash settlements or any of the tricks they've used for 50 years. Because the math doesn't work anymore. Let me show you exactly what's happening. As of right now, March 2026, silver open interest stands at around 85,000 to 91,000 contracts. Each contract represents 5,000 ounces. That's 425 million to 455 million ounces of theoretical delivery obligations. Against that, COMEX has 103.5 million ounces of registered inventory, and it's falling. Every single day, 785,000 ounces drain from the vaults. That's the current rate. If that continues through February 27th, there will only be 85 million ounces available when March delivery begins. Now here's where this gets terrifying. February 2026 just set a record, 98% delivery rate. 18.72 million ounces delivered from 19.11 million ounces of open interest. That's not a futures market. That's a physical allocation mechanism. People are not rolling contracts forward. They're standing for delivery, and they're doing it at rates we've never seen before. January was even worse. 49.4 million ounces delivered. That's 7.27 times the January 2024 level. In just 1 week of January alone, 33.45 million ounces were withdrawn from COMEX. 26% of registered inventory vanished in 7 days. Read that again? 26% in 1 week. So let me walk you through the math that keeps me awake at night. If March sees even 25% of contracts stand for delivery, COMEX would need 107 million ounces, more than will be available by first notice day. If the delivery rate matches January and February intensity, which has been running between 50 and 70%, we're looking at demands for 200 to 300 million ounces. Against available inventory of 85 to 103 million ounces. There is no scenario where this works. Now let me show you why this is different from anything that came before. The paper to physical ratio. This measures how many ounces of paper silver exist for every ounce of physical metal available for delivery. Right now, the March 2026 contract alone represents 528 million ounces of exposure against 113 million ounces of registered silver, more than 4 times the deliverable supply concentrated in a single contract month. Gold doesn't face this. March gold open interest can be satisfied with current vault inventory. Silver cannot. But here's what makes this a crisis and not just a problem. The acceleration. Total COMEX silver deliveries in 2025, 474 million ounces. That's double the 203 million ounces delivered in 2024. Every single month in 2025 saw higher deliveries than the same month in 2024. The pattern is escalating, not stabilizing. This is not profit-taking. This is front-running. Market participants are accelerating delivery requests before March arrives because they expect both opportunity and risk. They're securing physical metal before inventory shrinks further. And here's the part that should terrify anyone still holding paper silver. A significant portion of what's reported as registered silver is either non-eligible or already encumbered and not truly available for delivery. The pool of actually deliverable, fully eligible silver is much smaller than the headline figures suggest. When delivery notices arrive, custodians have to distinguish between inventory they control outright and inventory they control, subject to someone else, as rights. The real number, nobody knows for certain, but it's less than 103 million ounces, possibly a lot less. Now let me explain why smart money is doing something they've never done before. They're rolling backwards. Normally in futures markets, you roll contracts forward. You're holding March, you roll to May. You're holding May, you roll to July. That's how it's always worked. But in January 2026, traders started rolling March contracts back to January and February for immediate delivery. They're paying premiums to pull deliveries forward by weeks. This is the opposite of normal market behavior. And it signals one thing: urgent demand for immediate physical metal. During the first week of January, JP Morgan alone issued 99% of delivery notices, 8.1 million ounces, through 1,624 contracts. What made this unusual? January open interest increased by 1,431 contracts despite these deliveries. The metal is flowing out, the contracts are staying open, more people are lining up, and COMEX is running out of metal to give them. But wait, there's more. While COMEX vaults were draining in January, silver was simultaneously flowing to London at extraordinary pace. Why London? Because London lease rates spiked to 34.9% on October 9th, 2025. Intraday peaks hit 39.2%. When you see borrowing costs hit 200% annualized, that's not a normal market. That's a market where physical metal is so scarce that people will pay almost anything to get it. And here's what nobody in mainstream media will tell you. COMEX and LBMA, the London Bullion Market Association, are connected. When COMEX can't deliver, they source from London. When London can't deliver, they source from COMEX. It's a closed loop. And right now, both ends of that loop are under extreme stress. London inventories have collapsed to historic lows. COMEX registered stocks are down 70% from their 2020 peak. The system has no backup plan. Now let me show you what February 27th really means. That's first notice day for March delivery. On that date, anyone holding a March contract can issue a delivery notice. They're saying, I want my silver. You have 3 business days to deliver it. Once that notice is issued, COMEX has to produce the metal or settle in cash. And here's the problem. If even 30% of March open interest demands delivery, and based on January and February data that's conservative, COMEX needs 120 to 150 million ounces. They don't have it, they can't source it fast enough, and cash settlement only works if the contract holder agrees to it. So what happens if they refuse? What happens if industrial buyers, hedge funds, arbitrage traders say, no, we want the metal, not the cash? That's when the system breaks, because COMEX can raise margins. They can halt trading, they can change rules, but they cannot create silver that doesn't exist. And for the first time in modern history, we're about to find out what happens when a major commodity exchange cannot fulfill its delivery obligations. Let me paint you 3 scenarios for what the next 19 days might look like. Scenario 1, the managed settlement. COMEX convinces enough contract holders to accept cash settlement or roll to May. They source emergency metal from eligible inventory, from London, from wherever they can find it. They survive March, but registered inventory drops to dangerously low levels. Silver spikes to $120 to $150 as the market realizes how close we came. And every delivery month after March faces the same crisis with even less inventory. Scenario 2, the partial default. COMEX delivers to some contract holders but forces cash settlement on others. Maybe they prioritize industrial buyers over speculators. Maybe they negotiate payment above spot price to get people to accept cash. The market fractures into a 2-tier system. Physical silver trades at massive premiums over paper. Shanghai already trading $30 above COMEX. That gap explodes to $50, $70, $100. The futures market loses credibility. Physical becomes the only real price. Scenario 3, the systemic break. Enough contract holders refuse cash settlement that COMEX cannot deliver. The exchange declares force majeure. All contracts settle in cash at a government-determined price. The paper silver market collapses. Physical silver disappears from public markets entirely. Industrial buyers panic. Tech companies that need silver for electronics, solar panels, batteries, go directly to mines and lock up supply with multi-year contracts. Samsung already did this. $7 million prepayment to Silverstorm Mining for exclusive rights to 100% of mine output for 2 years. That's not market-based procurement. That's resource lockup. And here's what makes scenario 3 more likely than anyone wants to admit. The supply side is broken. 75 to 80% of silver production comes as a byproduct from copper, zinc, and lead mining. Higher silver prices cannot stimulate production increases if base metal economics don't justify operations. Primary silver mines are only 25 to 28% of global output. And those mines take years to develop. You can't just turn them on. Meanwhile, demand is structural and inelastic. China produces 80 to 90% of the world's solar cells. Every single one needs silver. AI infrastructure, 5G build-out, electric vehicles, medical devices. Industrial silver demand is growing faster than mine output. And once it goes into a solar panel or circuit board, it's gone forever. The amounts are too small to recycle economically. Global supply has been in deficit for 5 consecutive years. The 2026 shortfall is projected to approach 200 million ounces. COMEX is trying to deliver metal from a market that is already running a 200 million ounce annual deficit. Now let me show you why veteran analysts are calling March 2026 the funeral of COMEX. This is not hyperbole. A delivery failure would not merely be a silver story. It would expose the long-standing fragility of fractional reserve commodity, futures trading, and it could trigger cascading shocks across global financial markets. Because if COMEX can't deliver silver, what does that say about their copper contracts, their gold contracts? What does it say about every other commodity exchange operating on the same fractional reserve model? The financial system relies on confidence. Confidence that when you buy a futures contract, you can take delivery if you want to. Confidence that the exchange has the metal it says it has. Confidence that the paper price represents the real price. March 27th, we find out if that confidence is justified. 19 days. And the data says it's not. Here's what they don't want you to see. The backwardation. In a normal market, futures prices are higher than spot prices. That's called contango. It makes sense because storing and financing metal costs money. But silver has repeatedly flipped into backwardation. Spot prices higher than futures. That's a signal of extreme physical scarcity. The market is saying, I will pay more for silver today than silver 3 months from now, because silver today actually exists. Silver 3 months from now might not. The exchange for physical spread, the EFP, has widened to $1.10 per ounce. That's the premium you pay to convert a paper contract into physical metal. When that spread blows out, it means the paper market is failing to meet physical demand. And it's getting worse every week. Now let me tell you what's happening that most people are missing. While everyone was focused on the January 30th price crash from $121 down to $78, the delivery machine never stopped. February deliveries hit 13.8 million ounces. March open interest stayed between 85,000 and 91,000 contracts. The crash didn't resolve the crisis. It interrupted it briefly. Then fundamental forces resumed because the people demanding delivery aren't speculators. They're industrial buyers who need the metal. Hedge funds arbitraging the Shanghai premium. Sovereign entities building strategic reserves. China classified silver as a strategic material and imposed export controls effective. January 1st, 2026. 60 to 70% of global refined silver supply is now trapped inside Chinese borders. That metal is not coming to COMEX. It's not coming to London. It's staying in China. So when COMEX looks for emergency supply to meet March delivery, they can't call Beijing. That avenue is closed. And here's the timeline that should make your blood run cold. December 2025, major delivery month. 46.635 million ounces delivered. 50% of estimated free float registered inventory. January 2026, minor delivery month. 49.4 million ounces delivered, a 7 to 10 times increase over historical January averages. February 2026, minor delivery month. 98% delivery rate. March 2026, major delivery month. Open interest representing 429 million ounces. Registered inventory at 103.5 million ounces and falling 785,000 ounces per day. Do the math. By February 27th, registered inventory could be as low as 85 million ounces. If March sees a 70% delivery rate, which is lower than February, that's 300 million ounces of demand, against 85 million ounces of supply. The deficit is 215 million ounces. There's no vault on Earth that can make up that difference in 3 business days. So, what happens on February 27th? Here's my best guess based on the pattern. Day 1, first notice day. Delivery notices start flowing in. COMEX sees the numbers and realizes they're in trouble. They issue statements about orderly markets and adequate inventory. Behind the scenes, they're calling London, calling eligible inventory holders, begging people to convert eligible to registered. Day 2 and 3, more notices. The numbers get worse. COMEX raises margins again. They halt trading for volatility. They announce emergency measures. Maybe they extend delivery windows. Maybe they offer cash premiums. Day 4 through 7, the first deliveries go out. COMEX prioritizes certain clients. Industrial buyers get metal. Speculators get cash settlement offers. Some accept, some refuse. Lawsuits start. Day 8 through 15, COMEX is scrambling. They're pulling metal from every source they can find. Eligible inventory converts to registered, but not enough. London sends what it can, but London is also under stress. The price starts spiking because the market realizes what's happening. Day 16 through 21, the breaking point. Either COMEX finds enough metal to muddle through, or they declare force majeure. If they declare, every contract settles in cash. The paper market credibility collapses. Physical silver goes to the moon because there's no paper anchor anymore. And here's what happens after that. A 2-tier market emerges. Paper silver trades on exchanges at whatever COMEX says it's worth. Physical silver trades and private deals at 2, 3, 5 times that price. Industrial buyers bypass exchanges entirely and go straight to mines with prepayment deals. The futures market becomes irrelevant. Price discovery moves to Shanghai, which has been trading at massive premiums already. And anyone holding paper silver, ETFs, unallocated accounts, futures contracts, finds out their silver was never real. It was always just a promise. And promises don't conduct electricity or make solar panels. Now let me be very clear about what I'm not saying. I'm not saying you should panic. I'm not saying run out and buy silver because I told you to. I'm not giving financial advice. What I am saying is this. The data is public. The math is simple. March 2026 represents the largest concentration of delivery risk in modern commodity market history. And we're 19 days away from finding out if the system can handle it. There are risks to this thesis. COMEX could find emergency supply nobody knows about. Contract holders could accept cash settlement at rates higher than we expect. Governments could intervene. The March contract could somehow roll forward without triggering the crisis. I'm not claiming certainty. I'm showing you the data and letting you decide. But here's what I keep coming back to. This is the third consecutive delivery month where the intensity has accelerated. December saw 50% of free float inventory delivered. January saw 7 times historical norms. February hit 98%. Every data point says March will be worse, not better. And COMEX is going into March with less inventory, higher open interest, and a delivery rate that's already broken every historical precedent. 19 days, February 27th. First notice day. 429 million ounces of open interest. 103 million ounces of registered inventory falling at 785,000 ounces per day. Delivery rates at 98%, the math doesn't work. The system assumes nobody asks for delivery, and everyone is asking for delivery. There are 2 ways this ends. Either COMEX delivers metal they don't have, which is impossible, or they don't deliver, which breaks the system. There is no third option. The middle ground would require the delivery rate to drop dramatically in the next 19 days. And every single data point from the last 3 months says it's going the other way. So watch February 27th. Watch what happens when those first delivery notices hit. Watch how many contracts stand for delivery versus roll forward. Watch how COMEX responds when they realize they can't fulfill their obligations. Because what happens in the next 19 days will either validate 50 years of fractional reserve commodity trading or expose it as the house of cards it's always been. This is the silent ledger. The countdown is on. 19 days until we find out if COMEX has the silver they've been promising for decades. And the data says they don't. Now you know what's coming.